All right, so going into today, we were looking for one of two things to occur: this breakout to hold on the NASDAQ, or the resistance to hold on everything else. And so far, after today, we're still looking for those two things. NASDAQ is still kind of holding that move, not really extending it, but it's still holding it. But everything else is still languishing, and the nice good outperformance we had in some of these really good areas last week, it's not carrying through. We're still being led by a very small breadth. So I'm going to break down the technical signs that we're seeing here, and again, kind of showing that we still got some room to go here before we really are out of this concept of lower highs developing, and why this rally isn't as healthy, as great as it's been, as bullish and as fast as it's been. And even though we can still trade it and follow along with it and know how to do it because it's been that obvious, we also need to manage our risk, and there's reasons for that. And the red flags are propping up, and I'll show you what I'm talking about, and how we can be able to do both. Take advantage of the move that's being made and be able to manage the risk too. So let's go ahead and get started. Today is Monday, May the 11th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the market forecast indicator with the S&P 500, which is still hovering right around that 62% Fibonacci retracement level. You can see here about 29.35 maybe. It's really kind of got to push through. Now, if you recall, the NASDAQ composite has, especially the QQQs, it has pushed through, and it's held that breakout today after gapping down a little bit. It's so far holding that breakout. Remember, these are the two edges. The dotted lines are the two edges of this retracement zone. There's the move. This is the retracement. So, breaking out of these dotted lines means that you're starting a new trend, a new move. In this case, in the other direction, a trend reversal. And so that's kind of what you're looking for from the S&P 500 as well. And we're not quite there yet, but we're getting closer. And you got to break through this resistance. This is a resistance area, this 62.38. Once you break through this resistance area, then it starts looking a lot better, and you're kind of poised for a trending move, and then breaking out above 78 is a new trend. So we're getting a lot closer. The near-term line getting up into the upper reversal zone, kind of continuing to confirm this bullish posture. The near-term line now has been up above 54. Let's see, would that be 1, 2, 3, 4, 5 days now? Typical 7 to 12 days. So, it's looking like the beginnings of a bullish trend. It's also looking like a head and shoulders. So that's why, the continuation of what we talked about Friday is you got to hold this breakout move that's being led by the Qs, or this resistance will hold and gaps will start to fill, as you'll see here in just a second. The Russell 2000 is not quite there like it is on the S&P. We're not to the 62%. We're not even above the 50%. The one time we tried, we busted down, and now we've gotten up to it, and we're forming a little bit of a Harami pattern. Its near-term line did get in the upper reversal zone, so it is a positive development. And its posture, we got dark green shading in the green line again. So, in fact, we got that all across the board. There's your NASDAQ composite breaking through the 78% level. And then your Dow Jones Industrial Average, which, we talked about the NASDAQ, those big FANG companies using Microsoft instead of Netflix. Those make up, 45% of the Qs. Those 5 companies, they make up over 20% of the S&P 500. They only make up 14% of the Dow Jones Industrial Average. So that's why, again, your Dow is lagging. It's pretty much like the Russell 2000 is lagging. It has very little exposure to these large cap tech names that are driving the market right now. So they'll lag behind. It's not surprising. And it also has a very similar head and shoulders pattern developing. Developing doesn't mean it's a pattern yet. It's got to break down below the neckline, the whatever line you use to connect the lows in between the 3 highs. And obviously we haven't done that yet. So it's still just a developing pattern. And like I said, still has dark green shading and green line all across the board for the chart. So bullish trend. We're not obviously to new highs. We could still, as crazy as this sounds, because of how bullish we've been, we can still form a lower intermediate high point. Right? All these other intermediate highs have been higher. If I go back out a little bit further, you can see pretty much since this low point got us to a lower low, all the other, even the next intermediate high point, despite the fact that we went to a lower low here, the next intermediate high point, which ended right there before this pullback, was actually slightly higher. So, we've been getting, a high intermediate high point, then a pullback, then a higher intermediate high point, then a pullback. That actually went a little bit lower, then a higher, then with that big, tremendous move, a slightly higher intermediate high point, and then a pullback, higher intermediate high point, pullback, about an equal intermediate high point, slightly higher low, which wasn't even really much of a pullback. So really, this is one big move here to the upside, and we have a strong bullet, much higher intermediate high. So this would be our first lower intermediate high point that we've had in quite some time. If you go all the way back over here, here's our intermediate run that ended, higher intermediate high point. That one was a higher intermediate high point. That was a higher intermediate high point. You can call this pretty much one big one. This whole move in 16 was some slight interruptions here, but pretty much all one big move higher there. And here's another one that was slightly lower than that, but that was pretty much our first intermediate high point that was relatively lower than the previous one. And then that led to, you can see the type of move, the double dip move there. We've been getting higher intermediate highs all since then, until, as of right now, this move. So keep in mind how great this has been. Very similar to early 2019, but as great as this has been, it's still not, sniffing a higher intermediate high point anytime soon. And the last two that we had, like this one, it got up to it, and then it ran out of gas. This one got barely up above it, and it ran out of gas. Now it didn't, plummet down to new lows, but if these were the actual lows that we would have bounced off of, as absent that rate cut and the trade tweet that Trump had back there in December, kind of back to back, that caused that big decline that lasted about a week or two, that ended in Christmas Eve there. If you would have counted this as the low, then we pretty much got pretty decent distance to that low point there. So, but again, we ran out of gas, and that's kind of the idea on all these these big runs that we have. To get back up to that high takes a lot of momentum to break through all that resistance, and wouldn't be surprising if somewhere along the path here we start running out of gas simply because of the momentum. I think of it like a basketball team that's down 20-30 points, that makes up the difference by the time you get close to the end, or close to making up the difference, but then just runs out of gas because they spent so much energy making up the gap, only to end up losing by a few points here or there. So sometimes it can go one way or the other. That momentum can carry you through, but this is that's such a steep drop. It takes a lot of momentum, as we saw here. It can run out of gas temporarily, right? It didn't change the trend there. That pullback didn't change the trend. But that's something to kind of start looking for in this area of running out of gas. And now, like I said, that doesn't necessarily, with the Qs breaking up through here, I don't think that any pullbacks will change the trend from this bullish move. And again, led higher. For those of you who are premium subscribers to our website, we had our Q&A session Saturday morning. We spent about an hour talking about the comparison of this move here, this drop and bounce to 1998, 1999. Very, very good comparison because of this very similar type of environment that we're in, where large cap tech leads because a lot of things being pulled forward. Back then, personal computing, internet connectivity, all those different factors that were just building out, the World Wide Web and all those things, internet, retail, all building out back then. Well, now things are building, and there's the Y2K that pulled everything forward. Now, this remote work and mobile and 5G and getting everything online and smart devices all being pulled forward now because of coronavirus. Everybody's at home, and nobody wants to go back to work in small spaces. So the same story, different characters, but the same story, where large cap tech leads because even though the rest of the broad market is still kind of muddled by the economic ramifications of what we're facing, large cap tech is benefiting from what's being pulled forward And we saw that story play out. And if you saw the chart that we saw, after a couple of years by 2002, that gap in performance was made up. And I'll show you that here a little bit later in the video. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Also, hit that thumbs up icon down there. That tells us two things. Number one, you liked our video today. And number two, you want us to do it again tomorrow. So it's a quick way to give us feedback. We look at that on every video that we do to see what you're thinking. If you like our videos, let us know with one click. You can do that right now. If you don't like our videos, you don't have to click on anything. Or you don't have to watch either. Also, while you're down there, comment. What did you get out of our videos today? We'd love to hear what you're thinking. Join our website at marketscholars.com. There's a link popping up right there at the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Of course, if you're watching us on our website here, I invite you to check out our classes that we have. We do 8 different trading rooms throughout the week. Half myself, half Brandon there. We also have a couple Q&A sessions for our premium subscribers. But all of our monthly and premium subscribers get access to all of our trading rooms and our Market Outlook live trade review videos. I take a look at all the trades that we do in previous Market Outlooks and manage all those trades all the way to the time that we close them. For gains or losses, right? So you can kind of get the education from managing a trade, not just an idea of what to do. And then come down here. We invite you to click that heart. It opens up this window. Hit that like button. Also hit that thumbs up. That takes you to Facebook, and like our Facebook post there too. That benefits us because the more likes and engagement these posts have, the more Twitter and Facebook will promote all of our content to all of our followers. It also benefits you because they'll promote content in your timelines from the accounts that you engage with. So we try to make it really easy for you to engage with us here. All right, let's get back to our charts here, and you can see again what we're looking for is a higher high, which we have, a higher close, which again 1 day into it, but we have a higher close. The higher high will stick, right? That's the actual high of the week. It already is higher. Now it's not higher than the week before, so we'll see if we break through that range or not. And of course you have the 200-day moving average here. But we did have a higher close. That can change depending upon how we perform the rest of the week. And then no lower shadow. We have to fall all the way down. We're at 29.30. We have to fall to 28.42 for us to get a lower shadow. So pretty bullish candle, and we filling in the gap between the 50 and the 200-day moving average. That's how close we are to breaking through. Remember, the S&P already has broken through and is looking very strongly bullish there, and another good bullish candle. The Russell 2000, on the other hand, not quite. Right, it's got the decently bullish candle here, and it's just breaking above the 50-day moving average, and it's got a lot of gap to fill in before it gets to its 200-day moving average. And remember, this is more reflective of the actual economy, whereas the Qs are more reflective of again, the momentum and growth potential and what's working, what's being pulled forward from a broad market standpoint. That niche of all the different areas of the economy, specific areas of the economy, they're all being pulled forward right now because of this coronavirus. This represents pretty much the rest of it, right? The bulk of the economy, because that's what the U.S. runs on, this small business, and so it's still lagging, but it's trying. It's got a lot of space that it can still fill before breaking out itself to more of a bullish high point. We'll see if that actually ends up being the case. Let's look at the 3 green arrow charts for the S&P 500, and you can see almost back to 3 green arrows. If you take a look at the 2-line versions, you notice that the MACD is right up against its moving average. We are above, for the 3rd straight day, above a rising 8-day moving average. The stochastics is broken up above its moving average. So things are looking relatively bullish there from that perspective. Just kind of keep an eye on that, whether or not this ends up being a lower high point. If you take a look here at some of the other oscillators, for example, you look at the RSI and the CCI, and you can see we just cannot get above 60. As bullish as we've been here on the S&P, we cannot get above 60. We are on the Qs, which is good. That's a positive development, and we're not quite on the Russell. So we're not seeing that same broad buying all across the board where we can feel really confident about this. And in fact, if you look at the trend, which looks at volume, right, the ratio, not just advancers versus decliners, but compares that ratio to a ratio of advancing volume versus declining volume. They should be about equal, right? They should be about 1, but sometimes they're not, right? And sometimes, when you look at the ratio of advancers versus the decliners, it might skew towards the decliners, but now it's just a matter of how much volume. Is there more volume on the decliners than, when you compare the ratio? And what this is telling us with this moving average here going up is that even as we're getting more and more bullish, the ratio isn't 1. We're getting more volume on the losers than we are on the winners compared to how many losers we're getting, versus the winners. So in other words, the losers are losing more than what the winners are winning. And that's an issue. You want the winners to be winning as much as the losers are losing at the same ratios. But in this case, our losers are losing more than what our winners are winning, and there's more losers than winners, and that's not necessarily the best sign, right, for the markets, and that's what the trend is telling us. So a little bit of a red flag to keep an eye on. Other than like I said, the same thing with the the same thing with the RSI and the CCI. We're getting really close to breaking through where we need to here too. So we need to get above 80 and above 5, and we're above 80 on the trend noise balance, but we're not above 5 yet. That's when we can really get a solid trend going when you've broken through those levels. Obviously, QQQ has, same thing. We got a strong trend going. You can see how long these nice, good, strong trends can last, so that's good, and we've broken through there. But on the flip side of that equation, IWM still hasn't even broken through its cloud yet. So it's got some resistance in this area, and it's the same thing. It's stuck in the moderately strong 2.5 and above. So you need to get above 80 and above 5 for us to feel good, and especially break through this cloud for us to feel really good about the broader market taking off here and catching up, at least getting pulled along with the Qs. Let's take a look at the intraday chart. And this is the idea. So again, we gapped down today and we rallied and filled in the gap like as we normally do. It's a common gap. Common gaps get filled in. There's 2 common gaps here. That's the question mark is, are we going to follow the Qs up on this breakout, or are we going to fill in these gaps? Which one's going to hold, right? Well, you expect gaps to fill until they don't, because these are common gaps and more likely going to get filled. So which would mean that breakout doesn't have as good of a chance to hold unless, the Qs go up and the S&P goes down. And we haven't seen that big of a divergence yet, because usually when that divergence between the performance in the Qs and IWM recovers, everything goes down. So that's the big question mark. Are these 2 gaps going to get filled in? Much less this one from way back over here that we haven't filled in yet either, which is another common gap. And it's been a few weeks since we took off on that little bit of a rally. So that's the big question mark. You break through. If we come down, even just coming down here towards 282 would be a pretty significant decline. About 3% or so. But if we come all the way down to these lows, then obviously that would be a much more significant decline, about 20 points, and that would be well over 5% drop. And obviously that doesn't even include, which I think we're getting less likely of filling in this gap from way over here, which would be down below that 273 level. So we'd be getting kind of below this blue line here and making our way down into this area. And again, that's there's the runaway gap that I don't think we'll ever fill. But if we do, then I don't think we're going to be stopping at 220. I think we'll go all the way down to 210 and then some. But I think in any kind of worst case scenario, that's the gap that's to keep an eye on about whether or not it gets filled. And again, here in the more immediate term, this is the gap that we need to keep an eye on to see whether it will get filled or not. Because if it does, then that means this breakout is not going to hold. And the other issue that we have here that we need to watch this week is we need to get a new high point. Right? By the end of this week, this high tag, if we don't get a new high here in the next day or two and produce that high over here, then this high tag is going to end up over in this direction. And the low tag is going to end up in that direction too, because it's just going to always stay in this area as it follows this move up. Maybe pop out a little bit more after this day, we'll pop out over here. But that's a few days, that's a couple weeks away. So it's going to be in this area for a while, the low tag. And so the high tag is going to be there unless we get a new one. So if those two gradually move to this side of the chart, that's not a bullish. That's usually a reversal pattern. And so we'll kind of keep our eye on. That means we've been sideways enough to get a breakout, and usually we reverse. We get a breakout towards the downside because we'll have a really tight range, much tighter than what we've seen. If that were to happen, we'll see. We'll see. Again, if these gaps fill in the very short term, then that high tag stays. If we were to gap up and maybe get a new high tag, that would be before doing that. That wouldn't be so bad. If we were to gap up and stay up and never fill these in, and obviously that means we're following the QQQ path, and we're going to be bullish here. So, but again, the expectation is common gaps get filled, and so just keep an eye on those two. Those are really, really two important gaps to watch the next day or two, and I expect that they will get filled in. Let's take a look here at today's range and volatility, and you can see that the range is really tightening up to the point where the ATR is dropping like a rock. So 4 points, volume at 78 million. It's kind of moderated there. The volume has been. So if you take a look at where we're at here, 4 point range is way down here. So we've really fallen below that 3% mark, which is, again, we thought there was a very important support level that we've broken through. We haven't broken through 1% yet, but we've broken through that 3% mark, which when we get this bullish or this bearish, we usually form the low point after that. So again, if we follow the Q's path, then this is the low point for the market, right? Obviously that's the lowest, so that was the worst of the selling. But again, usually that low point forms after we hit that 3% mark, and it would be here, and we would take off most likely through 300, and that's going to be your breakout sign, right? If the Q's breakout's going to hold and bring the rest of the market up with it, then breaking through 300 is really important for SPY, because that's where your big resistance is. You break through this volume node right here, there's very little volume because of how low volume we were in these couple of months. Very little volume above us, away we go to the upside. Most likely that would also coincide with the Russell getting through this area, breaking through kind of this 135, breaking into that gap, and it's got some room to run before it reaches resistance. It wouldn't be new highs, but at least it would have some room to run here. So that would most likely coincide with a breakout, unless this catches up, like it did over here in one day last week, and then those 3 days the prior week. If it were to catch up, that's a different story. But there's a gap here in volume that it's got some room to run to catch up there. So that 300 level, very, very important. And you can see also from a volatility standpoint, breaking through 90% would also signify away we go, right? We're going to follow the Qs up for who knows how long. In 98, 99, it was about 18 months. But who knows how long. We're ready to go here. But if we hold this support and we jump back up to 100, 105%, then that means the intermediate line's pulling back. At least if we get to 105%, the intermediate line is going to pull back below 50. We're going to get an intermediate pullback. It won't, not necessarily new lows, but enough to fill in those gaps, and hopefully the Qs fall down there and we get some better value in some of those stocks so that they can give us a better, more sustainable long-term run coming out of it. So what do you think? Do you agree with that technical assessment? We're going to look at some other relationships here in a minute in our trade idea, but before we do, I just want to get your thoughts on this technical outlook of we're bullish. We've got to break out. We got to break out in one area of the market, and that's as a good leadership. It's not like we're being we have utilities and real estate and energy leading us up like they were earlier. Now we've got good leadership, so we can follow this leadership. It's not the greatest. We like to see it more broad, but at least it's the niche is a strong niche that can lead us, as we've seen in the past for a while. The question is the breakout going to hold, or some of these other kind of resistance levels in the other indexes going to hold? That's the big question mark going into it. And again, I've always used the mantra, which one? Which one is it going to be? I've always used the mantra, you expect resistance to hold until it doesn't. And when you do get a breakout, give it a day or two to make sure it holds and it's not a fake out, because those tend to be really negative, right? Either really bearish on the resistance breakouts, fake outs, or really bullish on the support fake outs. In this case, we got a resistance break on Qs, and if that holds, great. If it doesn't, as with everything else at resistance levels, we might get that intermediate pullback and that bounce in volatility. I expect resistance to hold until it doesn't. So we'll see. we'll see if this breakout holds. By the end of this week, I think we'll know. And I'm leaning towards that resistance holding until I see otherwise. And that's how I always will be with support and resistance. So what do you think? Do you agree with that or disagree? If you click, if you hit that link right there, it opens up a poll. You can hit either agree or disagree. If you click disagree, tell me why. What are you seeing down on your charts that would suggest there's a good chance this resistance won't hold and that we can really take off and get going from here? Obviously, everybody's got their opinions, but what's driving yours? What charts, what indicators are you looking at that you can share with our community down below? All right, now let's take a look at how these different asset classes are comparing relative to each other. You can see USO still struggling with, again, the nature of how that ETF is constructed with everything that went on with crude oil here lately. But let's take a look at how the market is holding up from the peak through the trough up until now, and which one has been performing the best. Right, if you notice, so here's the peak, the market dropped, and then we've rallied. The S&P is down 13% from that peak through the trough. Actually, it has to be, I need to go to the 20th, don't I? Because the 19th finished higher. So it's the 20th and the 21st. So I need to go here to 20. There we go. So there we finished down those 2 days. Then that was February expiration over here on the left, and then we started really down. And you can see long-term bonds are up during this period. Gold is up during the peak and the bottom and the trough. From top and almost getting back to where we are. And you can see preferred stocks and high yield bonds. High yield bonds are actually doing better. Only down 10% there. As bad as things were for them, they never did fall as much as stock prices did. You can see real estate struggling and still struggling. So it fell down the most during the bottom, along with small cap stocks, and you can see they're still lagging. Small cap stocks here are down about 20 some odd percent, 22%, while the S&P is down only 13.5% through the from the top to the bottom and back up. So that's not surprising for small caps to lead, but small caps should be the winners on the way back up here. So it's still kind of struggling there, not able to really gain any traction. And international stocks also, they dropped. And with the dollar being up here, not surprising that they would struggle. But the dollar is relatively flat, up a little bit, and they're still lagging behind. It's off of its highs. This is where the dollar was at its peak back on March the 19th. And from that, coming off those highs, you would see some outperformance in international stocks, and that's not the case. So until we can see international and value and small cap lead the move, then that's usually what leads off a major low point. So that's why it's kind of hard to put a whole lot into this bounce off of this low point because it's still the growth story, right? Very similar again to what we saw in 1998. I showed you, give me 1 second here. Here's the ratio of growth to value to growth, the ratio chart, and you can see how it's really been struggling. And this goes back to 20 years. So we've been down here before. This was back in 2000 where growth really took off relative to value. And we don't have, unfortunately, they don't go back before that. But if I just look at what's going on right now in the past year, you can see the strong negative momentum that we have, and it's kind of getting to a point where it's gotten to in the past. Very huge outperformance in value and growth versus value, way away from its 200-day moving average. MACD is trying to form a higher low point. We'll see if that ends up playing out or not. And then this RSI is strongly bearish. Again, we need to see some improvement in this before we can really feel confident about a lasting bullish trend. And you can see the same thing with IWM relative to QQQ. Same thing. You can see it's trying to base right now. And if it can break up above, now usually when this corrects, it corrects with all stocks falling, and that's the concern when it makes a big outperformance. So that's one thing for it to trend, and it's okay for the Qs to outperform during a regular trend. But once it goes parabolic, the correction of that parabolic move usually occurs with both IWM and Qs falling, with Qs falling more because they were the ones that went parabolic. You can see how strong the PPO is and the 50 to 200-day moving averages, and the MACD is working its way up towards zero, and the RSI is working towards the upper half of that chart. Let me show you a chart here. Here's a chart I was talking to you about. This is the performance of the Russell 2000 From an April 7th, this April low point in 1997, the markets had pulled back, and especially the Russell towards this 200-day moving average. Then it made a really good run. You can see the nice trend, and Qs led the way higher. It's like, okay, well, that's not too bad, right? And you can see the divergence corrected itself with both falling. And then Qs led the move off of that low point too. And during the subsequent pullback, instead of that gap shrinking, the gap got bigger in terms of the performance versus the NDX and the Russell 2000. Just got bigger during the pullback. Again, very similar to what we see right now, where we had the beginnings of a divergence. Then as we got more bearish, the gap just got bigger. And then as we rallied, the gap just got even bigger. The rally off of that low point. And you can see that breakout in the Qs, like we're seeing right now, led us up to a really good move. It lasted from October of 98 all the way through to March of 2000, where the Qs peaked. And that's the gap. By then, you can see how wide that gap did. To the point where, that was a new normal, right? These internet companies were going to be the new market leadership. They're going to lead us through, and this kind of broader market, this concept of a broader market was kind of gone now. We weren't going to go back to it. Well, we were concentrating, Microsoft and Intel and on all those big stocks. Now it's like Nvidia and Apple, and you have cloud stocks. So all those stocks are kind of taking the place of the JDS Uniphases and the Qualcomms of the world back then. Well, it took a while, but from March 2000 to about May of 2002, but by the end of October of 2002, and really July of 2002, and that's when the really big selling was. You had the multiple retests there. But by July of 2002, when the selling got the worst, you can see that all that outperformance and was up 462% off of that April low point versus only 70%. So almost 400 percentage points difference, almost. All of that gap in performance all shrunk, because while the Russell was flat for a couple of years because it had a really good margin of safety, didn't go up as much, the NASDAQ fell off of its high wire, and it came all the way back down to the ground. And then finally you can see, what ended up happening. In fact, a little bit of an outperformance there by the Qs. And then off of this low point, it was actually the Russell that outperformed coming off of here, which is what you want. And it doesn't have to lead the whole way, but it has to lead some of the way. And that's kind of the idea. And if you go back to the value stocks versus the Russell 2000 stocks, you can see in 2003, we never did get there with that whole pullback. But once we got to that 2003 low point, then value took off. Small caps took off relative to the NASDAQ. Value took off relative to growth, and you can see value led the way up most of that move. Value took off versus growth, and that's the type of market that did really, really well for quite a while. You can also see like international stocks took off relative to the S&P 500 all the way through that bull market. That's the kind of bull market. Now, it didn't during this, we had this bullish run off of this low point. The dollar was really bullish, and all these stocks have been underperforming this whole time. So this bull market that we've been in has been the complete opposite, right? Where, it was pretty much it's very much like the late 90s, almost exactly like the late 90s. Well, we saw how that story ended. We saw the multi-year pullback that occurred and the type of market it took to get out of it. And we'll see if that story ends up playing out again, just with different characters, right? Because of what's being pulled forward now versus back in the late 90s. But different characters, but very, very similar story playing out. All right, now let's take a look at how the sectors are performing. So let me come back over here to our sector comparison, and you can see again, let me just go back to 220 and see and show you who's been leading during this bounce off of this low point. So 220 of 2020 up until now. And let's go out to like an hour chart. So again, not surprising to see real estate and staples and utilities kind of leading. They typically hold up the best. Healthcare as well. Healthcare is typically a safe haven as well, even though like right now there's a lot of growth elements to it, right? But it's not surprising to see those lead the way higher on the way down because they tend to hold their value. But you notice by the low point, real estate and utilities were the big losers. They were well underperforming the market along with financials and industrials down here at the bottom. Of course, energy struggling. But then, through the downs and through the ups, you can see usually safe havens, by the time the market recovers, usually it's your safe havens are still outperforming through the down and the up because they held up better. But now that's not the case. Look at these utility. I mean, you have healthcare, but that's not the safe haven element of healthcare that's rallying. In fact, a lot of that element's struggling because a lot of these hospitals are struggling to make it. It's the kind of biotech space that's really been doing well. The growth element, the tech element inside, and you can see technology. Staples are doing okay too, and we all know why there, because we're all been stuck in our homes. But they've, the rally that they have has been moderated. It hasn't really gone up at all. In fact, it's gone down since this high point here, while the market's up and technology and everything else is up. But you can see industrials, financials, very cyclical elements of the market. Utilities and real estate, interest rate sensitive areas of the market, all really, and materials and energy also, economic growth sensitive areas, all lagging behind. I shared this chart on Twitter earlier today. Same thing, right? Same chart. Here's all the other death crosses that we got. Here's a death cross in late 2018 where the market dropped. It dropped about 20%. And then by the time it recovered, you can see your safe haven areas were still your biggest winners. The other cyclicals, you can see technology, discretionary, communication services were outperforming. That's great. But your safe havens held up the best, and then they did okay by the time we hit that low point. The next spot, you can see this is the 15-16 decline, death cross. We only fell 12%, but you can see utility staples. We didn't have as strong of a real estate sector there. And communication services wasn't a part of it yet. But you can see, they were staple. They were two of the best performers, and you can see discretionary and technology kind of matching the market. Here's the 11, the credit downgrade death cross. We ended up falling about 18 to almost 20%. You can see what led the way down, and staples and utilities holding up better there. Healthcare to a degree as well. They still were your big winners, along with technology. But by the time the market got back to its previous highs, they still were holding up. And then finally, well, that was it. So those three, 1, 2, 3. And this looks a lot different. So it's an interesting environment that we're in right now, where we're not getting that typical safe haven, doing well because they were so overbought. It's not your typical, this is not a bear market. As crazy as that sounds, as big of a pullback as this is not your typical bear market. In fact, it's not a bear market. It's a big decline in a short amount of time, but that doesn't define a bear market. A bear market is an extended decline over multiple months, right, and potentially years. And we're just not in that right now. It's as steep as this decline has been. It's been a nice, good rally, almost getting back up to it. And like I said, and the Qs are getting a lot closer. The XLK is almost there, and healthcare is almost back to those pre-February high points. So it kind of shows you who's the leaders and who's the laggards. And we, again, in 98, we saw this story before, and the Qs just continued to lead. Even though your cyclical areas were lagging, they got dragged up to a point where everything got pulled forward, in the tech space, and we'll see if that ends up being the case again here. And so if we're going to be bullish right now, we know what we want to, the market's being very obvious of what we want to be bullish in. All right, so that brings us to our trade idea of the day in this technology space, and that is actually it's in the communication services space, and that is Take-Two Interactive, another gaming platform. Like many others, you can see it's trying to break out above this old high point that we have here. We're getting really close to its own 52-week highs. You can see a strong bullish trend after getting the light pink shading here and close to a yellow line. But strong bullish trend on its market forecast chart. If you look at its 3 green arrow chart here, you can see that it's got 3 green arrows and a rising moving average. A little bit of a jump in volume here today. From a 2-line perspective, you can see the MACD and stochastics. Stochastics getting into the upper reversal zone. The MACD got a nice strong positive momentum here in the short term. If you take a look at its long-term chart, you can see we are in a golden cross environment and have been for a few weeks now, trying to break out of this little cup and handle pattern that you have going on. From a Bollinger Band perspective, you'll see that we are breaking through its value area today. So this little resistance that we have over here above us has got very little volume associated with it. So path of least resistance is to the upside. You can see its bandwidth is starting to rise there. You can also look at its Keltner channels, and when we looked at this earlier, it was breaking through its Keltner channel. We'll see if that ends up, if we end up breaking back out of it again tomorrow. From a CCI, right here, CCI RSI perspective, that RSI getting up above 60, breaking out this time and really holding. Didn't quite break out that time, but this time really breaking out. And from a trend strength perspective, that trend strength indicator getting above 5, the trend noise balance getting above 80. So really good patterns here all across the board on all these different indicators that we look at. The EMI getting above 25, the positive above 25, the negative already well below 20 here. So an opportunity similar over here for the negative, the positive to run, to get a good trend here for a while. And again, another stock in that the NASDAQ space, and a stock in the kind of the stay-at-home space, all right, that's showing some good breakout patterns, a little bit of a cup and handle right here on the daily chart developing too. So the gap in this cup would be your distance that we would shoot for the upside. And with the opportunity, very good directional move coming out of it today in our Market Outlook Live session. We looked at buying an at-the-money call. So we bought this at-the-money call. We put a stop order at 50% there. This is what it looks like. So here, let's get rid of this one. So there's our trade. We have a 50% stop order to get out with about a $580 loss. That ends up being right about here at 120. So in other words, for us to get stopped out, we'd have to break all the way back down here. So break through these highs, get all the way back down to these lows and beyond for us to get stopped out. So that kind of, and that would also mean too that we'd be breaking through some major support levels here. You got this big volume node up above that 120 area. So big time support, and so we have a good chance of keeping our risk at half of that 1100, so 580. And then our reward, if we just make a one standard deviation move to the upside, is $2,400 for that $500 reward. So good risk reward ratio that we have if it makes and takes off and makes a directional move, considering that we're out to September in this case. We got plenty of time to let it work itself out. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our forums on our website, and you can be able to interact with our community, ask any questions, open up any new threads, ask any questions, any comments you have about today's video, reply to other people's comments, and let's keep this conversation going in between videos here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between videos, and join our Market Outlook Facebook group as well as our community at marketscholars.com. Thank you again. Thanks. Have a great rest of your Monday night, everybody, and then we'll see you all tomorrow.